Hey, someone just told you that your company's 409A price is going up. What does that mean? Should you be doing something? Well, the answer is it depends. Let's break it down in some plain English now. Most employees don't realize this. When you join a startup, you are getting compensated in common stock. But investors, they're getting preferred stock. They are not the same thing. Preferred shares come with perks like liquidation preferences, dividends, and more liquid common stock. Well, this is what you get. It is less protected and it's harder to sell. So it's simply worth less. But here's where things can get confusing. If you've seen job offers quoting equity value based on the preferred, just know that's not what your shares are actually worth. It's a common mistake. We'll walk through what's real and what's not so you can make confident decisions. During recruiting, companies may pitch the value of your stock grant based on the difference between the preferred stock price and the common stock price. That is called the intrinsic value. And for you, the bigger the gap between the preferred and the common, the better. But be careful. This is just one input that you should consider. There are many other factors that matter more. So the next thing to discuss is, where do these numbers come from? Preferred shares are priced during fundraising rounds. You may hear this like your Series A, Series B, Series C, etc. So let's say an investor puts in $50 million at a $150 million valuation. We divide that out, and that's your preferred share price. We'll use this example of $30 later in the presentation, but you get your equity based on something else. This is called the 409A valuation, which is an independent assessment of the fair market value of the common stock. 409As are updated every 12 months or after major company events like new funding round or an acquisition. Now, your strike price of your options is the 409A price at the time of grant, and it never changes. And here's what's critical. The IRS doesn't care about the preferred price. They only care about the 409A because that's what you're taxed on. So if your company is doing well and that 409A goes up, any options you exercise may come with a tax bill. Let's now talk about what actually happens when you exercise your stock options. So the first thing is cash outlay. You'll need to come up with the money to buy the shares. If your strike price is low, great. Exercising might be super cheap. But if it's high, that can mean writing a rather big check. Second is your potential tax bill. Depending on the type of option and your current 409A price, you might owe taxes. This is especially true if the value of the stock has gone up since your grant. I won't go deep into NSOs versus NSOs and the respected taxes due here, which could include additional ordinary income or AMT. But I got a full explainer at the handle Nagy Knows Money if you want to learn more about the details. But let's move on. Third, you are now an investor. Once you exercise, you're not just an employee. You're financially committed. You're holding stock in your company that may still be years away from liquidity. That's real risk. Life moves on. Things like family additions, houses. But your cash is stuck and it's not guaranteed to be returned. So now I want to double click on those valuations. So let's look at this visually. The fair market value, or your 409A, often increases as the company grows. In this example, if you joined 5 years ago, your 409A might have been 50 cents a share. A year ago in 2024, it could have been $5. Well, today's new hire, they're getting a grant at $15 a share because you were just told of the new 409A increase. Under normal circumstances, 409As tend to stay pretty stable, except when a fundraiser occurs. Fundraisers generally cause large step changes to company valuations, which dramatically impacts the 409A valuation. So early employees might have gotten a 70% discount when there was only a Series A, but by the time the company is raising at unicorn status, the 409A is much closer to the preferred. And that leaves less room for upside as grants get a higher strike price. If you joined early, your grant was cheap. If you joined recently, it's more expensive. The exact same company, very different financial implications. Okay, let's walk through an example in a chart format to show a couple permutations. In this example, we're going to exercise 10,000 options. So even if you're an early employee, exercising your options isn't always automatic, but it can be a big win if you act early. In this top row, your exercise price is just 5 cents per share, and the 409A value is also low. Maybe 5 cents if you pre-exercise, your taxable spread might be zero, and your cash outlay is pennies. So we exercise our 10,000 options and we owe $500 to exercise. If we do it early, we lock in that value with minimum cost and almost no tax, which is a huge upside. But wait too long and that 409A climbs to say $5, and you now have a spread of $49,500. Now that same grant costs no more to exercise, but it triggers taxes and brings on higher risk. You can see it even gets more drastic at $15. You lose that window of low-cost optionality. For mid-stage employees, your strike price is already higher, say $5. If your 409A is now $15, your tax exposure balloons, so now you're weighing a $100,000 spread on top of a $50,000 exercise cost. Still a chance for upside, but with real cost and real risk. And if you are a later stage employee, your strike price and 409A are the same, both $15. That means your cash outlay is huge, and you're now owning an illiquid stock that might never pay off. So here's the key point. The longer you wait, the more expensive it gets in both cash outlay and taxes due. And you take on more risk with every step. Now let's go one step deeper here. This is where leverage comes into play. Let's bring back the concept of intrinsic value. That's the difference between what your shares could be worth one day, say the $30 preferred price, and what it costs you to get them. For early employees who exercised when the fair market value was low, they put up almost no cash, got minimum tax hit, and now hold shares with major upside. That high leverage, small investment, big potential payoff. That's a high leverage situation. But for later employees, or those who waited, they had to put in $150,000 of their own money just to own the shares, and with no discount. In this example, they would have committed $150,000 for the ability to earn an additional $150,000. They've committed real capital and taken on real risk with less upside. In summary, we're using leverage here as a shorthand for how much upside you're getting for the cash you had to commit. So if you're early, you commit $1, you can have $599 of upside. If you're late stage, you commit $1, you can have $1 of upside. This shows how optionality turns into ownership and why timing and strategy are everything when it comes to exercising your options. Let's now wrap up by bringing it back to the core question. Your company's 409A is increasing. Should you exercise? High 409As are generally not preferable for hopefully obvious reasons at this point. The higher the 409A, the more expensive it is for employees to exercise options. And when the valuation is closer to that preferred price, there is less upside for new or prospective employees. So what do you do if your 409A is going up? Well, it depends. If you joined early and your exercise cost is low, this could be a huge win, especially for ISOs. But if you join later and your exercise price is already high, you're now facing a large cash outlay, potential tax exposure, and increased risk. There's no blanket answer. It just requires some planning. If we work together, we'd model out your tax exposure so we have a full picture of income and tax liabilities. Second, we would run scenarios on when and how much to exercise. And third, we'd align it with your risk capacity and your goals. This would let us answer, should I exercise before the next 409A bump? what if I leave my company, and how does this equity fit into my total life plan? Because this isn't just about your options, it's about your future. Your equity is just a tool. Let's use it wisely. Want help mapping this out? Link in my bio.